Good morning, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 10:10 a.m. on February 16, 2019, Saturday. We have a terrific loyal member, um, Ms. Bolton, here in attendance. This is a advanced coaching session, group coaching session. We're waiting for one or two other members on the advanced coaching session list to join us. In the meantime, we are talking a little bit about, discussing a little bit about the overall picture in options trading and the markets in general. But this ACS coaching is going to be directly tied in with what we do, which is touch on different parts, aspects of options trading, correlate that with the charts that we use very effectively to trade options, and that's going to be our topic today. Fair enough?
Yes.
Right. This is not going to be a long-term market forecast and all that stuff that I'm going to cover on Monday evening's webinar at approximately 8 or 8:30 p.m. on Monday evening on President's Day. So we are ready for the following week. This is going to be more specific, targeted to looking at my Twitter posts, looking at the charts, looking at and how we kind of try to navigate this world of risk, what we call the stock markets. All right. So saying all that, full disclosure, this is purely for financial education, not for solicitation or advice. Any other members will be listening to this free session that will be uploaded to the Google YouTube channel, which I always remind everybody, please go tell all your friends, colleagues, anybody that you know out there who has any interest in the stock markets, through their own 401ks or who trade sporadically or whatever the case may be. Please go subscribe for free to the Google YouTube channel. All the videos that are put out there, what we call videocasts, are extremely resourceful, extremely precise. They give you the real picture of what the markets are not doing, not, as I always like to say, the garbage that you hear from the media and many other services which keep on spewing the same stuff over and over again. It is very insightful. The second thing is we have a Instagram account, which is Clueless A Trading Instagram account, and that was created a few months ago for promotional purposes. And I'm trying to get it in here through one of my other screens. This is the Clueless A Trading Instagram, and you can see here that the highlights of many trades that we did, not all of them. This is not a real-time content delivery. It is primarily for promotional marketing purposes. So the word and the phenomenal work that we do here at Clueless A Trading, as you all know, and the hard work that we put in to help all our members and subscribers constantly. Some of the highlights are put in there in the form of charts, in the form of ROI, return on investment on options, such as like this. This is ATVI. And I highly suggest that even if you do not have an Instagram account, like many members have done on my request, just create one and just follow. We have roughly 417 followers. That has grown, that has doubled in about 2 months. And we would like to get above 500, above 1,000. So the algos in Facebook, which owns Instagram, pick it up and run with it and show it in many different places. And we have a large following. This helps us promote Clueless A Trading. And more importantly, it helps us bring in new members who will also contribute towards the enhancement of all the different types of trades that we post. As you know, I like to, when a member can request a chart or a suggestion, I look at it, and if it meets the criteria, I certainly put it out there. So certainly do that. Please get all your friends and colleagues and family to follow us here on Instagram. It's exciting, it's fun, and I'm going to get better and better at putting in more frills in the form of visual dynamics, like many other Instagram accounts have, and that's going to, be a more pleasurable experience. More importantly, it is fun because this is what professional traders do. You can see what's going on, and most people out there have no idea what charts look like. Okay, so that's that. On that note, I was speaking to Trina on the option side. So when it comes to, I should leave it in there. When it comes to options trading per se, there are, as you know, the speed of movement in options can be extremely rewarding but at the same time extremely frightening. Am I right?
Correct. Yeah.
Exactly. The ones which move the fastest in many cases are the high beta momentum stocks, the Teslas, the Netflix, Apple not so much, Amazon, Google, Booking, and many others, Nvidia, just to highlight some of the bigger names that most people know about. So those are the high beta momentum, high speed driving, high performance type of options where they literally can deliver anywhere from 60 to 80 to 100% within a matter of either intraday or within a matter of 24 to 48 hours. I know, so you guys obviously know that. So the next ones have to do with the indices. Now, these also during certain extreme volatility periods, which happened quite a bit, and in 2018, as I was telling Trina, was probably one of the highest volatility years ever. In the range that the markets were moving in a week in the range of 600 to 1,000 points. It was, as you know from my previous webinars, as you know from my Twitter feed, those candles were just enormous, frightening in many cases, but at the same time, we managed to navigate that, not always very successfully on an intraday basis, but on a swing basis, we nailed it overall. And that is a testament to tactical precision trading, as we call it here. And what we try to do is keep our emotions in check, and that is obviously the hardest thing to do. 1 second, we have the other gentleman joining us. He'll be joining us any minute. So that is so what we're going to look at today, which will give a flavor of the different types of trades. One is the high beta momentum trading, the SPYs and the diamonds. This is the high beta, obviously Amazon thing. Look at these numbers. You know, these are big. These are actual reality of what was posted at their alerts. So what do you call them? So that's the fastest speed ones. And then you have, and those are swing trades too. It's not just that they always happen in a day, as you very well know. Then we have the indices, the SPYs, the DIA, the QQQ, the IWM. So you're trading the overall market without the direct risk of a single stock risk. Do you understand what a single stock risk is? Let me stop myself for a second. Drew, are you connected? Can you hear us?
Yeah, is my phone garbled up?
Yep, it's still garbled up.
All right, give me. All right, so I'll type until I get this fixed. I don't know why it's here.
I will tell you. I will tell you one thing. This typing stuff is extremely difficult for me to follow. But yes, for now you can ask the quick questions and stuff. But I did ask you to get a headset and a mic. Okay, because this takes a lot of time and energy. It's not the headset. Okay, dude, you try to fix it and mute yourself because it is extremely difficult. True. Can you mute yourself, please? Thank you. All right. So as we were talking, communication is very important in the business, whether it's a webinar, whether it's a tweet, you know, it has to communicate directly. So you have to have a headset and a mic when you're attending these webinars. Okay. So saying all that, I lost my chain of thought here. The other type of options is basically the swing trades, which we sit on for a couple of weeks. They're the biotechs, small to mid cap type of companies. And in the case of extreme volatility, where the markets are way down 3,000 points, you can sit on things for a couple of weeks. But intraday, they also fluctuate quite a bit. But the Clovis type of calls, right? They take, this is at biotech, this February 15, for example, we're still rolling with it. Clovis, as you know. And all of a sudden you wake up and these things will be up 300% because of some FDA approval, whether it's a takeover, whether it's a collaboration with a large pharma, all kinds of stuff. All right. So they are not necessarily day trading stocks. This wasn't a day trade. And you can see here very well when you look at the chart that Clovis has a long way to go if it gets there. And that's a lot of money. So these ones are the real big time lottery ticket winners, but they take patience. They take patience. The 75% from $1.30 to $2.28 is minor compared to what can happen if the company delivers, executes, or something else happens, which which brings it up above the $40, $50 level. Remember, at one point the stock was in the $90 level. So that's sort of a quick flavor of things. This is Booking, Priceline.com, always a ferocious mover. Options are always expensive, the premiums, you know that, but you can buy them out of the money, and you can do well. You can buy them $20, $30 out of the money because everything moves on a percentage basis. Booking is a $1,900 stock, so 1% move on Booking is $19. A 10% move on Booking, which doesn't really happen, has happened on earnings here and there, is a $190 move. So obviously buying call $5, $10, $15, $20 out strikes is a-okay, because on a percentage basis, it's just a very small move. Are you with me on that, Trina?
Yes.
Okay.
Yep.
Drew, you can hear us, so you're understanding what's going on. Okay. So that's it. So here we go. Now, one of the great things about the Instagram account is that, of course, the Twitter account is the real deal, because that's where the real-time content is delivered. That's where the actionable stuff you guys can play and make money on matters. But one of the things I try to do, and I'm going to obviously get better and better, is as I highlight, this was obviously a big day, and you can see the trades. Okay, these are all the high momentum stocks: Apple, Netflix, Tesla, Amazon, Google, Facebook, Booking, and then Anthem Healthcare was a big winner that day on earnings. You can see the type of numbers that are delivered. These are very large. And so one of the best things about this highlighting these type of trades and stuff is that at a glance, you can see, even though you might not be in that trade, at a glance you can see what's going on with the numbers. Because if you walk over to somebody and say, hey, I can't believe that he put out a trade and it was up 453%, which was the case with even so many of these earnings winners lately, with a couple of losers, of course, but net, the ones which move $15, $20, $30 on the earnings basket, they far outpace the loser one. I do a basket strategy where I can buy 1 to 2 calls each. So one goes up 500%. Remember, what's the maximum that you can lose in an option, percentage-wise? Trina. It's not a trick question, but think about it. What's the maximum you can lose on an options trade, percentage-wise?
100%.
Thank you. You'd be surprised how many people have no clue. That's right. What's the most you can make on an options trade that has gone berserk?
I don't know. It's indefinite, isn't it? Depending on.
Thank you very much for that answer. You're absolutely correct. You'd be also shocked how many traders don't know that answer. Upside is unlimited. It can be 453%. It could be 1,000%. It's happened here and there. We've showed it. On an options trade, the upside is limitless. The most you can lose is 100%. Think about that for a minute. All right. Same thing with the stock, but options are, you put limited amounts of money, and then if it goes, it goes. If it doesn't, it doesn't. That's absolutely correct. So if you make 600% or 500% on one and you lose 100% on another, overall net, you have to balance the position size, of course. Net, you're still up 200 to 300%, correct?
Yes.
Exactly. Yep. So that's the reason a basket strategy, both in our overall diversified options trading and specifically on ER trades, which are one of the best ways, in my opinion, overall, especially on the selective ones from my experience on Wall Street, my experience in trading, that the selective ones, I don't just go out there and buy all the earnings. They're like 570 earnings. I don't say, okay, go buy all 70. I'll pick maybe 5 or 6 choice ones. And overall, my track record has been pretty phenomenal on those. Please go ahead and review the Twitter feed and you'll know. Please review the Instagram account, you'll know. So bottom line is, out of that, if one blows up, second one does nothing, 2 just go through the roof, you're well ahead. You're up maybe 100+% on your overall basket. So if you put $500 into a basket, for example, there are many options which are like $1, $2. You can buy one each. The ones which are expensive are obviously the ones which are the large, large, high volatility, implied volatility. I try to put implied volatility plus minus 30. You've seen that, Trina, right?
Yes.
Exactly. What does that mean? That means, and Drew, or you're also listening to, that simply means that those are the ones which are going to move up or down 30, 40 points. So generally speaking, stocks above $100 will have an implied volatility depending on the particular nature of that particular company, a range of anywhere from $7 to $10. Chipotle, for example, one of the largest winners, both on the swing trade as well as on the option side on earnings. The options were expensive if you bought close to the money. $12 options, generally speaking, which were close to the money, went to $58 the next day. They opened up at 26. I actually sold a little bit early. They sold at 26, but then you can buy the ones which are, now that the stock is up $50, you want to buy higher strikes. You understand that part, right? If a $500 stock goes to $550, you want to sell the $550 at the open, take whatever profit you can, and then buy the $560, $570, $580 calls, because there's no point in you holding the deep in the money options, correct?
Yes.
Exactly.
Of course.
Simple stuff. Again, you would be surprised how many people don't gather this simple picture. All right. This is somewhere in this vicinity is where I'm running this webinar from. That's our neighborhood. So now you know. So on a bad day, I go for a swim on the murky waters. No, I'm just kidding. Yeah, that's our neighborhood in Jersey City, right on the water. So, okay. So saying all that, let us now dive in. And I think that's a good preface and a good preliminary talk on overall picture. And do keep in mind, for everyone else who's going to be listening to this, that the advanced coaching sessions, which are offered at a pittance of a price compared to what the other trading courses that other services run, which are in the thousands and thousands of dollars. And I teach far more advanced basics, advanced stuff, specifically on the chart side, specifically on trade management and how to use the charts effectively, so you keep your mind in a balanced state and you don't do emotionally unbalanced stuff in the form of buying and selling at the wrong times. Those advanced coaching sessions are basically very, very detailed. So we're going to get into it. So please sign up at your own time. Extremely helpful, and you will see the results almost immediately, in my opinion. Almost immediately. Okay, so now we get into good old Clueless trading, and we get into our bread and butter, which are the charts. So first we're going to go through a couple of quick charts. Keep it simple. And then we're going to go through, and then I'm going to take your questions and connect it with my Twitter feeds, so you can so you can see what I'm proposing and what can be done. Remember, trading, learning. I mean, the trade management and the trade learning process is also somewhat endless. You constantly have to adapt and finesse, and at one point you find your style. That doesn't mean nobody is a perfect trader. Nobody, because the markets are not perfect. So if the markets are not perfect, how can you be perfect? You can only strive to be on the higher echelon of tactical trading and not be swayed by your emotions. I have left more money on the table, and I think all of you can attest to that, by not participating in a trade or running with a trade, a rally, or a continuation of that particular run, than I have lost money in holding something that is that for no fault is down. And I think all of you can attest to that. Am I right in saying that, Trina?
Yeah, definitely.
No, really. I mean, I'm just asking a question because that's been my experience.
Yeah.
It's just like, you buy Netflix, as I'm showing it. I bought the market at the lows. We staggered the profits. Yet, some of it, we don't just let it run. Even though my charts are screaming, I'm saying uptrend, intact, blah, blah, blah. And one of the reasons behind it, one of the primary reasons behind it is what?
Just your emotions. Well, the volatility.
Thank you. You're answering all the right questions, giving A+. The volatility messes with our emotions because middle of the day, in 15 minutes, the market could be down 400 points. So even though our longer term charts are saying everything's okay, we don't know if that intermediate to long term chart or swing chart will change direction because of what happened during the day. The volatility is insane. The political volatility, the economic volatility, the Federal Reserve volatility. And that's the reason why we, in many cases, don't stick with the trade overall. Now, there's nothing wrong with that. You can always re-engage, but that is the real reason. Volatility is created, like I've said, always, to mess with our minds. Doesn't matter what level of trading you're doing, how professional you are, because you just don't know whether or not that is going to turn into a 600-point drop. Yeah, we kind of know by looking at the charts. But if it's sudden volatility, then, some of the ones we have been dead right on the trades through and through. And basically where the markets are going, we have a little bit more room to go, where we're going to hit a major wall, all that kind of stuff. Okay, so in order to manage your emotions, which means managing your trades, which means not doing stupid stuff, which means making a little bit more money or a lot more money than you're doing right now, which means participating in trades on a runaway market, which is equally scary as a crashing market. Because if you're short in a crashing market, I've done it. How many times have I taken the short out or most of it out, and the next day it's down another 300 points? So the same thing with rising markets. Rising markets have equal, difficulty for traders to participate in as traders shorting the market on a major trend down. It's a fact. And that's the reason why across the board, whether it's large institutions, big time hedge funds, big time Wall Street analysts that you guys see on TV here and there, and the average guy out there always has not completely, was missed out on a significant portion of this rally. Because every morning it seems like that little voice in the head says, oh my God, we're going to crash. Am I right or wrong? Yes?
Yeah, you never know what's going to happen, I guess.
Well, that is what's going to bring us to the next point. We never know. All right? We never know whether something's going to happen to us the following day. But we need to know what the roadmap is. So we do kind of know that. Yes. You there, Drew?
Is it clearer? Any clearer?
Much better, sir. Much better. Thank you. So
okay. Okay. Sorry about it.
No, don't waste precious webinars time apologizing to me. You're a good man. Don't be sorry. I'm glad that you somewhat fixed it till you go into the fish tank again, meaning like with that, thing. But let me continue with my thought, okay? Because I want to make this next half an hour to 45 minutes, and I'll finish around 11:15. Very useful. So the only way that you can control that mental part in the morning, like, oh my God, whatever, is tracking the chart. So looking at a particular chart, for example, like here, this is the ones that I live or breathe, because this gives me an idea what's going to happen to the forward market, which is the Dow Jones Industrial Average, the S&P 500, and the overall direction of the market. So first and foremost is the 15-minute chart. The 15-minute chart, this I just put it as a thing that if President Trump, if we have a US-China deal, which is still in the works, going well, and signs the government non-shutdown bill, which he did, then we're going to go here. Guess where we are? We closed here. You cannot get any more precise than this. And this I put, if you remember, you guys, you have to remember because you have to track the Twitter feed, and you can go back and track it. This I put days ago. I put this days ago, not on the 15th. I put it earlier last week. Based on my uptrend line, which started here. There you go. Based on this uptrend line, which met my criteria. What is the criteria? That it has to hit some major inflection points. 1, 2, 3. Based on this uptrend line, the markets showed that they overall wanted to go, and this is the same thing with charts, by the way, individual stocks, that the market wants to go somewhere in this vicinity. So that is going to be a major pattern completion, which matches in with all the longer term charts. Not that it can't go higher, but I'm just saying that's going to be the first major wall. So look where we closed at. We closed right here. Right there. Right there. So we have a little bit more room to move. We might get that Monday morning. And that's not much. That's we closed at 27.77, 27.75, going to 28.85, 27.85, 27.90. Again, is another 10 to 15 points. Now I'm going to ask this to Drew, and I'm not going to grill you on it, but you got to know this. If we move 10 points on the S&P 500 on the futures, the markets open up on Tuesday morning. Roughly how much will the Dow open up by? I've explained this to you many times. I asked you to write it down. Drew, please.
Yeah, I'm trying to think, to be honest with
Okay.
you. But 10 points. Looking at the chart, I would say with 27.
I didn't ask you that question, sir. And Drew, you have to get this right, because this is an ACS session that you're attending. So at this point, I will literally demand that if you do not write this basic thing down that I've asked you 4 times since the last webinar, if you remember, right? You do remember that, right?
Yes, I do remember that.
Right. So you're basically being a bad student. And if you're going to be a bad student who refuses to help yourself, you're going to keep on losing money, which you are. So I'm going to, do you have a pen?
Yeah, I do.
Please write it down this time. Roughly one S&P point move is roughly 6 to 7 points on the Dow Jones Industrial Average. Should the S&P, did you write that down? One S&P point.
Yeah, what?
One. Let me write this down for you. Hold on. One S&P point is roughly 6 to 7. That's the factor. Okay, 6 to 7. This is extremely important because this helps you when you're doing a trade, whether you're sitting on any other, like, you know, pretty much like, okay, it's reached that level, the Dow's up this much, and it automatically helps you with your trade management. So Dow Jones points. So I'm putting D Dow Jones. So if it's 10, if we move from where we are to where I'm saying that we will most probably open up on Tuesday, and then there's going to be a quick sell-off right at that level, because it always does. Every single one of my resistance levels creates a sell-off, and then you buy that sell-off based on the ranges. So if it's 10 S&P points, we move. How much will the Dow Jones roughly be higher by on the opening on Tuesday?
60 to 70 points.
There you go. So now you have it. Can't go any wrong with this. All right, it's real simple. This is second grade stuff.
So
right?
here,
go ahead.
But here's my question though. I don't even understand like when you're looking at the
go ahead,
the SPX and how it relates to the Dow. I don't even understand that part. Well, I understand it to an extent of being logical.
Okay, the reason that's a very good question. The reason I related to the Dow, because the first thing that even traders automatically mentally associate the market with is how much is, when they say how much is the market up or down, right? When you hear in the media or like thing, we're always talking about the Dow Jones Industrial Average, right?
Right.
Exactly. We're trading. As technical traders, we're using the S&P 500 to create a roadmap on other trades, because if the S&P 500 is down 50 points, that means the Dow is down 300 points. Then whatever stock you're in on the other side is also going to be down. You understand that part, right?
Now that's making more sense. So,
No. Let me.
Okay.
This is what you're asking, Drew, is a very good question, and it's so basic that it's going to help people who have absolutely no clue about the markets. Because your question is so basic, it's like asking is 1 + 1 = 2. So let me explain this in a very simple way, and it's a very good question, mind you. The S&P 500 is what? That's 500 of the largest companies in the United States. Okay? So that's S&P 500. What's the Dow Jones Industrial Average? It's 30 of the largest corporations in America. The McDonald's and all, Walmart and all that stuff. It's called the Dow Jones 30 Industrial Average. Okay? So there's a basic stuff. So if the S&P is the Dow Jones is the 30 largest company, what's one of the biggest ones in there? Boeing, which has been one of our biggest trades. So when Boeing is up $5, the Dow is going to be up roughly 40 points. You follow me so far?
I'm following you.
Yeah, this is real simple. What you are doing, you're completely disassociating these major indices, the Dow Jones Industrial Average, the S&P 500, the NASDAQ 100. These are what are they? They are just baskets of the biggest and the most powerful companies that are traded on the market. So if these indices are down, that means all the components within those indices are down. I hope you understand that, right?
Yeah, I understand that.
Drew, what I'm hearing is confusion. How can you be confused about something this simple? Okay, let me try to make this real simple. Stocks trade in the stock market, correct?
Correct.
Good. The stock market is subdivided into different components as in indices. Dow Jones Industrial Average. And it's a very good question because this is literally like me teaching somebody who has no idea about the markets. You have idea about the market, but you don't have an idea about like this basic stuff. So let me explain to you. So it's a very good question. Dow Jones.
That's why I signed up. That's why I signed up for your class.
No problem. You didn't tell me that you were there. That's fine. I got to put in some more work, which is good. Okay, Dow Jones Industrial Average, and this stuff, by the way, I'm going to direct you to some basic Google, YouTube videos. You need to listen to it on your own. All right? Because now I have identified the issue because this is like before you take you get your driver's license, you got to learn how to use the brakes and do the steering wheel and all that stuff, right? So I'm going to guide you to the right tutorials because my job is not to teach this basic situation. I'll give you the tutorials that the guys will. You listen to it 15 minutes, then explain to you the basic stuff, and then I'm going to move you along the way. Is that fair?
Yes, sir.
Exactly. Good. I like that. So Dow Jones Industrial Average, S&P 500, then you have the NASDAQ Composite, which is known as the COMP. This is NASDAQ. This is where most of the tech stocks, the biotech stocks, the growth stocks reside. Then you have the IWM, which is the Russell 2000. That's one of the widest measures, basket of stocks, 2,000 companies in there. So within the stock market, which is the stock market, there are these indices. These are the indexes. And each of them have a certain amount of stocks in them. All right? So what happens is when these things, if S&P being one of the ones which are most widely correlated with the overall movement in the market, when the S&P is up or down, all those 500 stocks within the S&P 500, that's the full name for it, are going to be, not all of them, but a good portion of them are going to be down. You understand that part, right?
Now I do, as you're explaining this. Yeah.
Okay. Look, stocks trade within the basket. That basket, I'm just focusing on one. S&P 500. There are 500 stocks in there. Those 500 stocks are the big shots. Apple is one of them. So bottom line is when the S&P 500 is down, that how can your stock be up? You understand what I'm saying? Drew, I need an answer here. I mean, this is not difficult.
No, yes.
I don't know why.
No. The answer is yes. I want to get off mute.
Okay. The bottom line is that if S&P 500 is down, that's the reason why we follow the futures. If the S&P 500 is down, that means some major heavy-duty stocks are under pressure. That means the market is going to be overall down. When the S&P is up, that means the markets are going to be up. That's the reason why we follow these roadmaps to figure out whether or not the markets are going to be up or down. So I hope that's as clear as day, right?
Yeah, it's clear.
Is it clear? Or, if you're not getting it, I'm going to, how can you not get it? I don't understand that part. This is a basket.
No, I get that part.
Okay, good.
Yeah,
good.
I get that part.
I'm a great reader of people. When I don't hear that level of like, I got it, then I have to question and try to help you, because like, I got it. It doesn't quite cut it, because it seems like you're not getting it. You're just saying it because you don't want, that's why I said that. You understand what I'm saying?
Yeah, no, I'm good. I understand that I'm brand new.
That's it. Stop.
With a knowledge, but
stop personalizing.
I understand what you're saying.
Drew, stop personalizing the stuff. It doesn't matter whether you're brand new, whether you're 5 years, because you told me a different set of stories, like you've been trading for a bit and this and that. So I didn't realize that you didn't understand this basic concept. That's why I'm taking the time to explain it to you. Okay?
Right, because you're very tactical, very intelligent.
No.
I've been looking at it from a totally different angle. So okay. For me, this is a totally different way of looking in the market.
That's totally understandable, and it's a very good comment. I accept that. So let's move on. So basically, and that's a point that I want to highlight a little bit here, Drew and Trina. We look at the market like a surgeon looks at a patient. We look at the market where we are seeing the moving parts of the market. So if one of the moving parts of the market are starting to crack, we generally get an earlier directional signal, which I put out there so that you don't fall into harm's way. It's not that easy, but overall, the reason I've been so accurate in the markets going higher, or where the markets are going to pull back to, look at each of these levels that are engaged, is simply because I'm structuring my charts in a way where we know where the pitfalls are and where the rewards lie. Now, you don't need to be a market technician. You just need to understand a little bit of the information that's coming out of my charts. That's all. That's all. Okay? And there's very simple ways of doing it. The rest of the structuring and stuff, that's my job to do. And we have traders who are very who are technically savvy or have gotten there through the advanced coaching sessions, through being on my service. So they create their own charts and they move with it. So yes, you're correct. We do not look at the market the way other people look at the market. Why? Because that's stupid. Market's up, let's go buy. Market's down, let's go high. We don't do that crap. We buy technical oversold conditions. We buy, that's the basic picture. And we sell technically overbought conditions, which I know you know, Drew, because we have talked about it before, right? So so that part you understand. So bottom line is that and I try to make it as simple as possible with these arrows and all that stuff. So this is a short-term chart of the market. Overall picture is showing that we still have room to go, but we can have these very sharp drops that happen from nowhere. And each candle, it's a 15-minute chart. So each of these candles are 15 minutes. You both are with me on that, right?
Yes.
Exactly. So you can see that within a certain day, you could have these wide swings. Each of these swings can be hundreds of points. Each of these candles could be 30, 40 points on the Dow Jones Industrial Average. So the average person who's trying to trade the market is getting completely whipsawed and losing money almost every day because the machines are moving the markets in this fashion. Yet, if you look to see where the markets have come from since the 10th of just a week ago, it has gone higher. But has it gone higher in a straight line? No, because markets never do that. It has gone from here to here. That's a lot of money. Now, along the way, it's done this. So if you were a trader not trading charts, or at least understanding the charts, you'd be blown out of the water every 15, 20, 30 minutes. Yes or no?
Yeah.
That's a very powerful comment. So understand that. You're going to be blown out. Yet the markets have gone up hundreds and hundreds of points. We were up 480 points on Friday, and I kept on saying, buy those SPY calls, buy the SPY calls. Do you know how much the SPY calls were up on Friday?
It's like 380 points, right? Like 300, 400 points?
I said the call options. What the percentage
call
return.
option.
Yeah. Let me show it to you for you guys to fall off the table. Now, did I make all of it? No. Did I make a good portion of it? Yes. Did some of my members make a good portion of it? Everyone should. Everyone should. Because I said, keep on buying those. They were up anywhere from 200 to 600%. It didn't rocket science. All you had to say buy and leave it in there. And where is my, 1 second, I'm trying to bring this out. So here we are. I highlighted that on the Instagram account just for promotional purposes, but you guys already know. Please look at these numbers. The SPY, the ones expiring on Friday, lottos, you could have bought them at 20 cents. They went to $1.60. 662%. So you could have put they were 20 cents. You could have put $200 on Thursday. And I did tell people to buy this and for next week. Okay? The 276 calls, I actually tell people to buy this from last week. You put $200. How much would that $200 be, sir? So $200 means you had 100 calls. Sorry. You had 10 calls. 1 second, Trina, don't answer.
Okay.
So SPY 276. You know how to read Feb 15. There were 10 cents. So if you bought 10 calls, it cost you at 20 cents. And we do a lot of these, as you know. That's $200. You're with me so far, Drew?
Yeah, I'm with you.
You understand how to read the option symbol that I put out there, right?
Yeah, I understand that.
Okay, good, because that's important. So this is a SPY 276 call, Feb 15 276 call. That means it's expiring on Friday. These are known as Friday lottos. Okay? So Feb 15 276 call. We call them Friday lottos. Why? Because they're expiring on Friday. So you win big or it doesn't work. The lottos are 20 cents. The following day, they were $1.60. So you had 10 calls at 20 cents. And how much did and they went to $1.60? How much did you make?
10 calls.
You do. I mean, let me ask you a question. Stop you for a quick second. And this is a question, so answer me directly. You have traded options, correct? Just asking a question, Drew. You have traded options, correct?
Yeah, no, I have. I mean, it would be 1.6 minus 0.2, which would be 1.4 to figure out what the profit is.
Bullshit. Bullshit. Stop.
No, that's not right.
I'm telling you what would be the net. Drew, you have traded options, right?
Mm-hmm.
Right.
Okay. Just keep it.
So there wouldn't be 1,400?
What would be? I'm not asking the profit. I'm asking you 10 calls you bought at 20 cents. That's $200. So the same 10 calls at $1.60 would be how many dollars? It should take
1,600.
Why does it take you so long to answer that? You're an options trader. You should know this the back of your hand. All you do, one contract, right? One contract, whether it's a call or a put, is how many shares?
One contract?
Don't repeat.
I don't know how many shares it is.
You need to know the basics of options. I'm going to direct you to a very specific video. 2 of them. You need to listen to it before you even trade a single dollar next week. All right? You need to know these things. It's 100 shares. So basically, when we say 10 contracts, it basically means you're controlling 1,000 shares. You got it?
Okay.
Yeah. Now, 1,000 shares at $1.60 is $1,600. So your profit is $1,400. So you put $200 and you made $1,400 overnight over a 24-hour period. That's how options trading works. If you follow my alerts, and I'm not saying this happens every day, but it happens a lot. So that's basically what I'm getting at. So if I was not tracking the charts on the SPX, I mean on the actual market, in my opinion, is not the Dow Jones Industrial Average. The actual market is the E-minis, which is the futures market, which is the same thing as the S&P 500. You understand what the ES is, right? Okay,
No.
Okay, good. So I wanted you to say no. ES simply means that this is the futures market for the S&P 500 and the SPY. Got it? You understand that part? You understand what a futures market is?
Yeah, I understand what the futures market is.
What is a futures market?
The futures market is going to be the future of the stock. I mean, not the future of the stock, but
the market. The market. In other words, the
market.
The futures market trade literally 24/7, right? So the bottom line is, no, you're right. So the bottom line is that the futures market is this. See, S&P 500 futures. So what happens here will determine what happens to the S&P 500, will determine what happens to the SPY, the spiders, which in effect will determine what happens on the Dow Jones Industrial Average. Yeah. So now you see the correlation?
Yeah, I see the correlation.
Yeah. And what happens to the Dow Jones Industrial Average or the S&P 500? They don't always move hand in hand, but 90% of the time they do, will have a direct effect on your trade that you're doing. You understand that part? Because that's the closest thing to home, because you're either going to make money or lose money, right?
Right.
Exactly. So now you're getting the linkage. There's simple stuff. You have to understand this part before you even trade a single dollar. Okay. So saying all that, the key is, and this I'm addressing to Trina because she's a little bit, she's been trading for a little bit longer, and she knows things. So Trina, basically focus on the 15-minute charts. That one of the best ways to trade the market right now, aside from my specific stock thing, is stick to the SPYs. The SPYs are cheap. They have a directional bias, meaning up or down, depending on the charts where we're going to. This is a 15-minute chart, so this will give you the intraday stuff. This is a chart which is, if you whether or not we're going to. I personally think that we are going to get close to 2,800 or maybe overshoot a little bit. So the SPYs are the best way to go. I have a whole bunch. I have a whole bunch of SPY calls, which you did go through my Twitter feed, right?
I did, yes.
Okay. What was one of the extreme SPY calls that I asked, not asked people to buy, suggested? They were the 280, 283 calls, right?
Yes.
The 283 calls, I paid as low as 5 cents. As low as 5 or 6 cents. You know where they closed at the close?
No clue.
Almost 10 to 11 cents. I doubled my money already. Okay? And those are the ones which are the 283 SPYs. That means the market has to go above this. On any type of China deal, believe me, the market's going to overshoot 2,800 real fast. So bringing Drew into the picture, the 200, these are the ones you should be maybe looking at, cheap calls, Drew, till you start to understand what's going on. So the 20-cent calls are good because if you lose some money, you're not going to lose too much money. You get it? So the ones that sometimes I buy extreme calls because I think the market's going to go through an extreme move. The last move on the market for the short term will be an extreme move. Means 400 or 500 points. Bang. Friday was an extreme move. So my 5 cents I paid for my calls. You could have put $500. You could have bought 100 calls. 100 calls. And please stop me if you're not understanding. If you bought 100 calls at 5 cents, how much money is that, Drew?
500.
Okay. By 4 p.m., those were, and you can check these are the 283 calls. It's on my Twitter feed, so it's all there. So this is for expiring next week. Next week is February 22nd. They were roughly 5 to 6 cents. They closed at 10.5 cents. What happened to your $500? What happened to your $500? Thank you. Would you feel like a rock star if you took 500 and turned it into $1,000 in a day?
Absolutely.
There you go. There you go. That's what you got to do. Now, the way I teach members who are in this very basic stage of understanding is a 5-cent call is the same. If you move the decimals over, it's like a $5 call. Okay? It's like a $5 call that went to $10. So when a $5 calls go to $10, people get pretty excited. Yes?
Yes.
Right. When a 5-cent call goes to 10 cents, most people don't get excited because it's a law of numbers. In your head, it doesn't carry the same weight. You got it? But the percentage, so the percentage returns are the same. That's what happened with these 283 calls. If the market gets here, which it's most likely it'll hit here, and then we'll see what happens, but it looks, overall channel looks that it wants to get this to this level before it stalls a bit. If it gets here, these 10 cents will be almost $1. That means you just made yourself, if 5 cents goes to $1, what percentage return is that?
To $1.
Yep.
95%.
Jesus.
Hold up.
I'm going to fail you in math and boom, right now.
You're absolutely right, Frank. $1 from 5 cents to $1.
Look, 5 cents went to $10. That's 100%. So 5 cents goes to that's 100%. 5 cents goes to $1. How much is it? Okay. What's 10?
I'm just out of it. Maybe I'm just mentally just out of it at the moment.
No, I don't. No. I don't care if you're out of it or not. You're in. This is football boot camp, man. All right, simple math. I'm going to, if you divide, okay, if you divide 10 by 5, what is it? Come on. Thank you.
2.
So this is the way it's simple math. It's a simple math. Okay. So 1. So imagine this to be 10. This is how you do math. All right. So you imagine this to be 10 and this to be 5. 5 cents to $1 means 2,000%. So your $500 that you put in, that $500 that you put in goes to, if it goes there, if it goes up 2,000%, right? So 500, because this is the reality of what happens. Hold on. I'm going to make this exactly right. The $500 that you put in goes to $10,000. If I told you, and I've shown this before, that you could put $500 into a trade, and it's happened before, and you took out $10,000, you think you would, how would you feel?
Like I was going to have a real good night?
Real good night. You'd be shitting bricks. You'd be like, damn it. You just made yourself $9,500 in profit, right? Because you put 500 and you took out 10,000. And this type of shit has happened in these markets I shouldn't say quite often, but it's happened. Trina, you've seen that. Okay? And this can happen. Very good possibility of happening if the market ramps up exactly to this upper level of this chart. I know my members, some of them have done it. And it doesn't take rocket science. All right. Saying all that, the only way that you're going to stay in that type of trade is by looking at this chart. So let me ask you a question, and this is going to help you, Drew. When you look at this chart overall, you understand what is this called? What are these two lines? What are they called?
I don't know. I don't know what those two lines are called.
Okay, it's called a channel.
Okay.
Okay, it's called the channel. So the channel, like this, anytime there are two lines going like this, it's a channel, right? Sideways channel, uptrend. Now, is this channel uptrending or downtrending?
That's an uptrend.
There you go. So it's an uptrend channel. This is what?
Downtrend.
There you go. So as you can see, this is what we say in technical analysis, and this is very important. When you look at this first glance, what does your brain tell you? Are we crashing and burning, or are we going higher? First, like something that hits you within 0.1 of a second. When you look at this chart,
it's going. When I look at it, we're in an upward market. When I look at this overall chart,
I'm talking from a technical standpoint. When you look at this uptrend channel, as you correctly identified, the uptrend channel. Where looking at this chart here, where can the market go? Where will the move go to? To which part?
Towards the 2810, the 2820.
There you go. So that is see how the market's moving within a channel, and there is a mid channel here.
Yeah.
See that? That's kind of a mid channel right here, sir. Right? And we close to the mid channel. That's how you look at basic chart reading, so that when you're sitting on that trade of buying the SPY calls at 5 cents or 50 cents, that most of the times it's not 5 cents, it's more like 50 cents or $1, you don't freak out as long as the general directional bias is higher. Now, once it hits the mid channel, is it possible, like it did here, that it might pull back a little bit? That's possible, correct?
Yes.
This one didn't just overshoot higher and hit this. It vacillated, pulled back, freaked out people on Thursday, and then on Friday took off like a rocket. You see that?
Yes.
Exactly. So is it so this is how you recharge. So basically this line here, it's possible that is part of a resistance. You understand resistance and support, right?
Yes.
Okay, this red line is a resistance. This is a resistance here. Lower end of the channel is a sorry, what am I saying? Resistance. Support. Support is lower. Resistance is higher. Right? You bounce off support and you hit resistance. You generally basically pull back. Understand that part, right?
Repeat that for me.
Okay. This is resistance. This is support. The support is the floor. The resistance is the roof. Right? So generally when you hit the roof, unless you crack through it, you're going to basically stall there. You understand that part, right?
Yeah.
So that's it. So when you look at a chart like this, that's your roof. That's your floor. And intermediate, there's a couple of floors or supports so that the market can pull back and do what it needs to do. So my job is to show these things quickly, and as time goes on, the sooner you understand these, the better. Then you know not to get out of a trade, even if you are down on that, as long as the overall visual picture is telling you that it is within the uptrend channel. You understand what I'm saying?
Yes.
Exactly. So Tillery was a prime example. That time it was an uptrend channel, whatever. You were down in the stock and then you managed to sell it for a profit. Remember?
Yes.
Exactly. So now, 11:09. So I'm going to leave. Trina, go ahead with. I'm going to pull in my Twitter feed here, and Trina, go ahead with a question. What's your first question?
Just a random question. Why did the market take off right at the end of the day yesterday?
Okay, that's not a random question. It's a very good question. What happens is with the markets is there are large hedge funds who are basically shorting the markets on a consistent basis based on the fact that the markets are reaching elevated levels, right? So, so the key was that when you looked at the overall picture of the market, this was during the day. This was Friday. This was Friday. Yeah, so this was Friday, okay? So look what happened on Friday. This is when the market started trading at 9:30, right here. See? 9:30. Yep. And this is why pattern chart reading is so critical. So which was 9:30. 9:30, the market burped open, right?
Yep.
Exactly. Then for the next, remember, this is an hourly chart. So each candle is 1 hour. Drew, you understand that, right?
Yeah.
Each of these candles is 1 hour. Just the way the other one, each of the candle was 15 minutes, so it's a lot more candles. How many hours of trading are there in a day? Well, from 9:30 to 4, 10 to 4, 6.5 hours, right? There's six and a half. Yeah. I'm sorry?
Yeah, you're right.
6.5 hours of trading a day. You got it, Drew?
Yeah.
Why? Why is there a hesitation in your voice? Or is it?
When you say 6.5 hours, and maybe I'm crazy. I mean, when you all right, so from 9 to
okay, why don't
oh no, you're right. No, I'm thinking about something totally different. You know what? You're good, Frank. I was thinking about something else.
And just on a note, yes, you are a little bit confused. All right, 9:30 to 4 is it's 2.5 hours till noontime, and 4. That's 6.5 hours. See, I caught you because the first time you didn't understand. You're like thinking, what's he talking about 6.5 hours? So that's why I say I'm a good reader of people. You know, I don't need to see you to know when you're confused. So that's why I'm trying to help you. So the market started
off. I'm gonna be a superstar, Frank. Don't worry.
What was that?
I'm gonna be a superstar. Don't worry, Frank.
No. Let me explain one thing to you. Traders like you, and I mean this, so listen carefully to what I say because I've been teaching for a while and I've been doing this for a while. Traders like you generally, over time, become some of the best frigging traders ever. You know why? Because you're starting from frigging right at the bottom, understanding the basics. So it is true. It's like somebody taking me and training me for the triathlon. I'll probably be frigging good because I didn't get triathlon, then get fat, and then do triathlon again. Like if somebody just took me and said, that's it, 4 hours a day, hardcore, CrossFit, all the hardcore thing done, and then so you're dead right. You will be. Now, in order for you to get there, you need to basically focus a little bit more on the basic stuff so that you move along fine. But your passion is there and your commitment is there, and that's all that counts. So I agree with you. So, but feel free to ask any question. There's no dumb question. All right? There's no dumb question. So the markets started here at 9:30. And Trina, I explained this to you and Drew. And for the next 4 hours, 1, 2, 3, 4, the markets just move sideways. So the market started here. So this is why I say always try to educate yourself through the multiple videos I have on my Google YouTube channel on pattern symmetry and what these patterns mean. The introductory video where I explain to people what a falling wedge is or a breakaway gap or all that stuff. That stuff you got to teach yourself. You both agree with me on that, right?
Yes.
Yeah. You have to, because once you get a basic grasp of that, then when I'm explaining things, you'll get it. So basically what the markets did was they opened up like this on Friday. And then for the next 4 hours, they moved sideways. What does that look like, Trina? You know this pattern.
Consolidation.
What is the pattern called? This is called the consolidation thing. It's a bull flag.
Well, yeah, correct.
Yeah. See, you need to go back too, Trina, and study all the video. Like really memorize it. Like to me, the patterns just come naturally. Okay. So, and it's not rocket science. So basically, the markets they opened up here, and then for the next 4 hours, And of course, while it's happening, we don't know, but I'm monitoring the levels and I'm showing it. Nothing broke. No levels broke, all that stuff on my 15-minute chart, so we're good to go. And then when it's a bull flag, what do bull flags normally do?
Go up.
Trina?
Yeah, they take off.
That's exactly why it took off. What time? What does the time show here? What's the time here? Look at the bottom.
Like
2
1
o'clock.
o'clock?
2 o'clock. 14 military time is 2 o'clock. So 2 o'clock, the markets took off. Bang, bang, bang. Now, did it go in a straight line? No. It did this. That's why we mix and match the charts. There. Let's make this bigger. Where is 2 o'clock? Where is 2 o'clock? Here's 1:30. Here's 2. Here's 1 o'clock. Here's 2 o'clock. So you see what happened? This is 2 o'clock.
Yep.
So I kept on monitoring the 15-minute chart based on many different indicators and stuff. The simplest one to indicate is the stochastics because it wasn't crashing. When it starts to crash, that means the market's going to pull back. Simple. You don't need to know anything more. So I saw that the market was just trading in a range. That was your range. That was your consolidation bull flag range after the opening break. Get it? And when the market was doing this within the range, that's when the market was moving back and forth 50, 60 points. You understand that? But the bull flag was intact because of the support. Here was your support. That's why I have a red arrow. If it broke this, you could short the market a little. But it never broke that. It stayed within this pattern. See this pattern? Drew, do you see this pattern?
Yes.
There you go. So it kept me on the long side of the trade overall. Now this is, I'm talking about the spies and stuff. And in answer to your question, Trina, bull flags break out. When the shorts realized, oh Lord, they're not going to pull this market down, they had to cover. I'm going to ask Drew this, when do short sellers or somebody short in the form of SPY puts or other puts, when do they lose money? When a stock goes up or down?
When stock goes up.
There you go. Just the way most of the time we're long. So as long traders, we buy calls, we lose money when a stock goes down, right?
Right.
There you go. So if you are short, which a bunch of funds and stuff were short, and the market basically did nothing and then started to break out, remember, there was a chance the market would pull back here, which I cautioned people also, right after President Trump declared the national emergency on the border thing, right?
Mm-hmm.
So this is something more advanced, and this is something which will come. That's my job to warn people. I wanted to see the reaction of the market because the markets did pull back a little bit when he announced that stuff, but they never cracked. They never cracked this support level. So if it didn't crack the support level, the people who bet short, and these hedge funds were betting hard, like, okay, market's going to drop now that the national emergency, this thing is complete like hogwash and it's going to create massive confusion in the market, all that stuff. They said, oh my God, we got to cover. As Drew correctly pointed out, they had to buy back what they shorted in order to minimize their losses. That's why the market shot up like this. And it shot up exactly within the parameters of this chart. Going to the middle side. Got it? And this is not the only one. I showed multiple charts as to what it do. So does that answer your question?
Yep. Thanks, Frank.
Now on the opposite end, when the market is on a primary downtrend, which looks like this, the primary downtrend, does the market go straight down, Drew? When the markets collapsed, I'm going to show you this in the form of a picture. And this is very important to keep in mind. As a trader, we are playing staggered moves in the market most of the time, right? We are like the professional futures traders, the ones who've been doing it for 30, 40 years from Chicago, from New York, Wall Street. These guys, you know, I've met a couple of them. Those guys never make the 600% type of profits like we're showing. They just take the meat in the middle consistently. which is a good strategy. So if you take 60, 70, 100, 200% in the middle, instead of going for the juggler at 660%, you are generally you're gonna last longer in the business. You got it? So they always say they trade the ranges. They don't trade what's eventually gonna happen. So we do the same thing. Did you guys understand what I just said?
Yes. I wait for a trend and then I get it.
True. I'll explain again. They trade these ranges like we do. Okay, it moved up here. We're going to sell some here. Looks like it's going to move up here, so we'll buy it back up here. They trade the ranges. These are ranges, right? You understand what a range means?
Yeah, I'm good there.
Yeah, range simply means levels. That's all. So a professional trader will trade within within these ranges. Because if you buy it here at 11 a.m., you don't know whether it's going to go here. Am I right or wrong? I don't know whether it's going to. I know that it's going to at least get towards these levels, or at least here. But I don't know it's going to end here at the end of the day. Do you understand that part?
Yeah, I do.
Okay. So that means that you trade this. First, you trade this range. You take nice profits here. You look to see how the market's reacting here. You don't even have to do this yourself because I'm putting these charts out. And then here it got really choppy. When it hit here, I asked people to take profits. Go through my Twitter feed. Profits on the SPYs primarily. And then as the market started to surge, you can trade this and close out your book at the end of the day. So here's my last thing that I wanted to impress upon both of you. And I know Trina's... This is a picture of the E-mini futures from October of last year. Okay? So when you look at this picture, does it really look like the market's just going to crash Tuesday? Hey, it can. Something could happen overseas which would be devastating. That's different. Those are black swan events. You know what a black swan is? It's like a swan which is rarely seen, and when it's seen, it means bad luck or an unquantifiable event. All right? Not bad luck. It simply means that something you can't quantify. So generally speaking, this is telling me that the markets will go at least a little bit higher, possibly here, and then you got some big selling. So the point that I want to make is that throughout this whole move, we don't know that it will eventually get there, even though my charts were showing. At each of these major levels, there was selling, a couple of 100 points, and then once it broke out of this, what's this line called? Drew, what is this red line going from the high touching here? What is this red line called? Quick. I don't have all day. Come on. Please.
I was on mute. The roof. The resistance.
No. What is this line called? I know it's resistance, but what is this line called? It's called the downtrend line. All right? It's called the downtrend line.
Okay.
And this and these two lines are called what? You just answered it earlier on.
The green. Yeah, you have the roof. You have the roof, and you have the support.
No, this is called the downtrend channel. See, the channel's going down. You got it? Yeah. It's this. This stuff is basic. You got to self-teach yourself this stuff. I'm going to send you some links on the video later on. Okay? I mean, this is the downtrend channel. Okay. This is simple. This is common sense. If a road is pointing down, that's your downtrend channel. You understand that, right?
Yeah, I understand that part.
Okay, good. So this was your big downtrend channel. We completely broke out of it for a week, broke down from it for a week right before Christmas, and now we are just breaking out of the downtrend channel. So given that we just broke out of the downtrend channel, we haven't even gotten back to where we were in December and November. So we still have a little bit of more room to move. So if you're playing the SPYs, Trina, you want to be looking at the long side unless we take out some major support levels, which are in the 2,700 range. Got it?
Yep.
That's it. On the SPYs, time is good because you're busy during the day. So always buy a week out or so. And in between, generally, we get a pullback on Wednesday, right? Generally, we get a pullback on Wednesday. So you might want to wait till Wednesday. We shall see. But whatever's going to happen this week, going into the end of the month, as long as the flow is, oh, Drew, these two blue lines, what are they called?
Upward channel.
That's right. Uptrend channel. So are we still within an uptrend channel? Yes or no? Quick.
Yes.
Exactly.
Yes.
Exactly. Now I'm getting up to speed. So if we're within an uptrend channel, what is the upper end of this channel? Because that's the upper end of the channel, right? 20. Oh my God, that's 2,900. I won't even go there. That's like, wow. That means the market will be up 800 points from here on the Dow. Who knows? That is the upper end of the channel. Along the way, there are these green lines, which are the roof or the resistances, right? So I am looking at a short-term resistance at around 28.25, which means we are going to be up another 50 points on the Dow. On the S&P 500. Drew, 50 points in the S&P 500 is how much on the Dow Jones Industrial Average? I asked you to write
300.
There you go. Exactly. 300 to 350 points. It's roughly a factor of 6 to 7, right? So that's 300 points. You're right. So max move. What is a max move? Max move means the maximum upside I'm expecting within the next week or earlier is 300 points on the Dow. Now, here's the interesting part. The Dow closed at 25,883. If we add 300 points to the Dow, where do we go? We go slightly above 26,000, right? Correct? Guys, yes. Say yes.
Yes.
Okay, say yes. Need to get better headsets or faster internet speed. By the way, both of you need faster internet speeds. Spend a couple of extra bucks to get, I'm not kidding. It's for your trading and everything. You know, you need faster internet speeds. I have the fastest internet speed, doesn't even cost me that much because I screamed at Comcast and they gave me a good deal. It's called 1 gigabit. I got 1 gigabit of speed. You guys must be running on what, 200 megabytes a second, right? Or something?
No, I'm actually I'm on fiber. I'm on fiber. You should upgrade to fiber.
Well, I forgot. You're the juice, man. You were at with Verizon, right?
Right.
Yeah, there you go. You know this stuff. Who am I talking to? Yes, you're on fiber. That's the best. They don't have fiber in my neighborhood because of the water and all that stuff. Anyway, that's a different thing. So basically, the market at this point, just keep it simple. Looking at the charts, I know you guys both got it wants to go slightly above 26,000. Now, along the way, this is the risky part. If it breaks, this is the lower end of the channel, right?
Yes.
Right.
Right? What is it? What's the number, roughly? Look on the right-hand side.
27, 20, 2721.
Yeah, that's right. 2722. So in other words, if we break below this level, there is a support level here also. But if we generally break below this, that means the market will quickly pull back a little bit lower. Nothing devastating, but it can do that. Within the uptrend channel, the market can easily test the lower end of the channel because markets tend to go like this. End of story. So, on a closing note, I think you got a drift of the overall charts. Trina, I refreshed from a refresher standpoint, and Drew, from a basic standpoint.
Yeah, definitely. Thanks,
Sure.
Greg.
Okay, and what do you call? I will touch. I will be doing a webinar on Monday evening. And Drew, I will touch base with you later on today or so and see if I could fit you in another class this weekend. Okay?
All right. Thank you.
You can just, in the meantime, I will send you the links so you can go through some basic stuff on options and everything. Very, very important. And you just have to go and spend, like I said, 20, 30 minutes, scroll through my charts, that have been put out there over the last 48 hours, Thursday and Friday. So when we do our next session, advanced coaching session, you will be ready with questions. Write it down on the side, both trade questions as well as chart questions, how to read my posts when I'm putting out a trade out there, like, how I'm buying it and stuff. And so we'll be more prepared. Fair enough?
Fair enough.
You guys are fantastic. Thank you for attending. Have a blessed weekend. It's Maryland weather must be the same as Jersey weather right now. Very nice outside.
Yeah, it's not too bad at all.
That's good, man. You got some plans for today?
No, I'm just gonna pretty much recover from yesterday. That's about
okay.
it.
So you were out with the boys last night, or what?
Oh, it was a good night.
Well, let me just put it this way. Let's move it this way. The fact that you attended, and I mean this, the fact that you got up to attend the 10 o'clock, hardcore training session on trading shows your commitment. And my hat's off to you. I'm dead serious because I'd blow it off. Okay? So that itself shows how far you can go. I mean that. Okay? And Trina, your commitment is always commended, and I will be working with you more. All right?
Sounds good. Thank you, Frank. Have a good day.
Rest up. Take care, guys.